Thank you everyone for joining us for today's webinar, Accounts Payable Automation 101, sponsored by Corcentric. My name's Mark Brousseau. I'll be your presenter today. Chances are accounts payable automation is on your department's agenda this year. It's the #1 priority of organizations, and there's no surprise why that is. According to your controllers, accounts payable is the most paper-intensive and labor-intensive finance and administration function. And that's really saying something when you think of F&A dogs like tax and audit and accounts receivable, which are all burdensome in their own right. Controllers also believe that accounts payable is the function that would benefit most from automation. And I agree. And today, we're going to provide you with a roadmap on how it is that your organization can automate its accounts payable department. As I said, my name's Mark Brousseau. I'm the Managing Director of Advisory Services for IOFM, the largest accounts payable and accounts receivable trade association in the world. I invite you to learn more about IOFM online. If you have any questions during the course of today's webinar, I encourage you to use the Q&A panel on your screen. Send those questions to me electronically, and we'll answer them at the appropriate time. If we don't get to your question during the webinar, we'll do it after the fact. So why is it that accounts payable departments are so eager to automate their function? Well, when you look at what it is that sets best-in-class accounts payable departments apart, it's three things. First is their efficiency and their effectiveness. Second is their level of automation. And third is their cash and spend management. Now, this is all fixed, folks, because the fact is that automation underlies all three of these attributes. It is what fuels efficiency and effectiveness, as well as effective cash and spend management. We're going to show you that during today's webinar. But to give you a sense of why it is that best-in-class organizations are able to use automation to their advantage, let's take a look at a couple of new benchmark statistics from my friends at IOFM. First is cost per invoice. Think for a moment about what it costs your organization to process its invoices. I know it might be cringe-inducing, but do it anyway. For organizations with a high level of accounts payable automation, it costs them less than a quarter of much as it costs those organizations with a low level of automation. Now, of all the statistics I'm going to give you today, this is the one that I want you to take with a grain of salt. It's not because it's not right. It's because I believe that the cost for folks with a low level of automation is grossly understated. We know that 40% of all IOFM members don't track their invoice processing costs. Perhaps you don't either. And if you don't track your costs, you probably don't know the full depth of the problem with manual and semi-automated invoice processes. So I believe that most organizations are spending far more than $8.78 to process their invoices in a low level of automated environment. I also know that highly efficient accounts payable departments, those with a high level of automation, they're able to process their invoices much cheaper than $1.77. But good luck trying to achieve those best-in-class results if you're pushing around paper and you're manually keying invoice data. What's more, when we look at the number of invoices that an FTE can process annually in a department with a high level of automation versus those with a low level of automation, the differences are staggering. In fact, organizations are able to achieve more than 15 times as much productivity if they have a highly automated environment versus their peers. What's more, if you combine a high level of automation with a high percentage of PO-based invoices, now you're able to process upwards of 25 to 27,000 invoices per year per FTE. That's a staggering improvement in terms of productivity. Think of what you can do with all that free time. Well, the problem is that in an environment with limited automation, you spend 84% of the average staff's time on heads-down transaction processing, literally from the moment the invoice arrives at your doorstep. You've got to manually open the mail. You got to key that invoice information. You got to track down the approver. You got to physically route the document. You've got to manage any exceptions that turn up, which turn into back and forth emails and phone calls. And then once you've got an approved invoice back, now you have to manually key the data into your ERP system. You're going to typically cut a paper check, which requires more printing, stuffing, affixing postage. And then there's the inevitable reconciliation on the back end, as well as fielding all those supplier inquiries about invoice status, as well as payment status. Oh my goodness, no wonder we get so little real work done. With automation, we can put our staff back to the things that add value, the things they were hired to do, financial functions. That'll make accounts payable more appealing when you're trying to attract new talent. But it's not just costs and productivity where automation plays a big role. It also has a big say in the percentage of invoices paid on time. This is the #1 metric against which accounts payable practitioners are measured. CFOs are mindful of the percentage of invoices your department pays on time. And if you want to pay your suppliers on time, you need automation. 84% of accounts payable practitioners believe that late payments to suppliers is a fact of life. I said it's hogwash. Organizations with automated accounts payable processes are paying 98 or more % of their invoices on time. And as a result, well, they don't pay late payment penalties. They get fewer calls from suppliers regarding invoice status. They're able to capture more early payment discounts. They have better visibility into where their company's finances stand. They don't have a backlog of invoices. And everyone in their organization is genuinely happier with the accounts payable function. Automation also helps you root out those dreaded duplicate payments. Duplicate payments chip away at profit margins, and they cost your business a lot of time as well as money. For many organizations with a low level of automation, you just have far too many duplicate payments. A good rule of thumb at IOFM is that any duplicate payment percentage above 1% suggests you have a vendor master file that needs a good weeding out, or you have invoice processes that are simply ineffective or inefficient. Well, for many folks with low level of automation, they're sitting on duplicate payment rates of 2 and 3%. This is a tremendous burden to the business. Best-in-class organizations, well, they have about 1/6 as many duplicate payments. So here again, automation helps you automatically detect those duplicate payments, puts in the checks and balances so you don't have to think about it. Automation also helps organizations capture more early payment discount opportunities. 70% of CFOs want more opportunities for early payment discounts. Now, that doesn't mean they're going to take advantage of every one that comes in the door, but they want the opportunity to do it, for they realize that early payment discounts help you reduce your cost of goods. It also helps you build relationships with your suppliers. That's right. Some suppliers simply need accelerated payments, and they're willing to offer you discounts in exchange for a payment ahead of the invoice due date. Those payments can add up fast in terms of discounts. In industries such as pharmaceutical, high-tech consulting, consumer packaged goods, 1/4 of buyers report that they're able to capture early payment discounts between 6 and 12% of the invoice due amount. But if you're trying to do this in a low level of automation, good luck. First of all, you probably can't approve the invoice in a timely enough manner to capture a meaningful discount. Moreover, it's a burden trying to manage this. More phone calls, more back and forth emails, convoluted reporting, terrible reconciliation. I wouldn't bother. So here, automation helps you capture some of that money that today you're literally leaving on the table. So whether it's high processing costs, poor staff productivity, errors, long approval cycles, or lost discounts, automation helps. And the common denominator is that it helps you root out those paper-based processes that cost your business time and money. So how is it that you should go about automating your accounts payable department? One of the things I hear many times from organizations is that it's overwhelming. There's literally dozens of solutions providers to choose from, and there's many approaches to automation that complicate the whole picture. Well, let's give you 6 steps to automating your department, taking you from a paper-based environment to best in class, where invoices are processed in a fully electronic, touch-free manner. The first step to automating accounts payable is scan and capture. Folks, paper is a fact of life in invoice processing. And while the percentage of paper invoices you receive is no doubt declining, they're also not going to disappear anytime soon. And even if you move to electronic invoicing and you have a successful rollout, you're still going to be left with an inevitable amount of paper invoices. The question is, what do you do with them? Well, scan and capture offers a solution. It provides you with 3 components to eliminating the burden of managing paper invoices. First, it provides you with intelligent scanning so that it can electronically classify documents to determine what's an invoice, what's a purchase order, what's expense report. It allows you to electronically sort these documents and then apply business rules to them based on the document type. It then extracts the data based on the business rules for that document. So, for instance, on an invoice, well, we're going to need the invoice number, the invoice amount, the due date, as well as the vendor name and perhaps a code. And if there's a purchase order attached to it, well, by all means, we want that as well. So we can automatically match that invoice up against a purchase order without physical document handling. And throughout this process, you want the ability to automatically validate the data that you're extracting so that you can look for any discrepancies and cleanse the data so that it doesn't become a downstream headache, i.e. when it gets to your ERP system. Now, there's a lot of approaches to scan and capture, but one big consideration is whether you want to do it in-house or via an outsourced operation. Internally, there's some burden to scan and capture. You have to make an investment in equipment. You have to make an annual maintenance contract. You might have interruptions when your equipment inevitably breaks. You've got to train your staff to use the hardware and the software. You're on the hook for handling any OCR exceptions, OCR being optical character recognition, the automatic interpretation of printed data on an invoice. When that data is misread or it's not able to be read, your staff is going to have to take care of it. And you're probably going to need your knowledge workers to be able to do that. What's more, you're still managing paper. You haven't offloaded that burden completely. So as an alternative to managing this process in-house, more organizations are looking at SaaS outsourcing, cloud-based outsourcing. In this approach, you no longer need to invest in equipment or in annual maintenance costs. You have no risk of having your solution go down because the equipment is broken. You don't have to train your internal staff. You don't have to resolve any discrepancies in data. And you don't have any paper to manage. It's all been offloaded on a third party who's holding the bag and who is committed to service level agreements with you. So you can have peace of mind that the work's going to get done appropriately, on time, and per fixed pricing. And when we think about how it is that the best in class are capturing invoices, well, they're already using scan and capture. Best in class organizations, 79% of them are using scan and capture. That's a 10 percentage point increase over all other organizations. So if you're not using scan and capture, chances are you're falling behind your peers. As I suggested, The second component to automating your accounts payable environment is electronic invoicing. Now, first, a level set. What is an electronic invoice? I know a lot of you are receiving more and more PDF invoice email attachments. Those are not an electronic invoice, no matter what certain vendors tell you. An electronic invoice is a digital document that flows electronically and in a touchless environment from your biller's system to your ERP without the need for human operator intervention. The reason a PDF isn't an electronic invoice is that for more than 2/3 of you, you have no software for automatically managing that document without human operator intervention. What's more, even in cases where that software is available, there's many, many instances where someone has to intervene. And because so many electronic invoices can be processed straight through, that means without anybody ever touching it, now you can reduce your costs by 60 to 80% compared to manual paper-based processes. This is an eye-popping cost savings. And folks, it's available to businesses. Organizations are actually achieving even higher cost savings, those that have a high percentage of PO-based invoices. And the question becomes, just how much adoption can I get with electronic invoicing? Will my suppliers actually go for this? Well, this is a chart that shows you a typical curve of where organizations will go in terms of adoption. What you see is that by the second year, it's reasonable that an organization will see a 70% adoption in electronic invoices compared to paper. And there's a number of ways to achieve this, including targeting your suppliers, looking for high volume of invoice suppliers, and rolling out a program that clearly communicates the benefits to them. This is realistic. But as I said earlier, it's unrealistic to believe that you're going to completely eliminate your paper invoices within 2 years. So be leery of any vendor that suggests that that's the case. And be certain you have a way to manage those paper invoices as well as your electronic invoices. Now, one approach to electronic invoicing that you'll no doubt hear about as you start to look at automation is this idea of supplier networks. So these are cloud-based networks where suppliers and buyers basically log on to electronically exchange invoices and other information. And while this allows for secure and fast exchange of invoices, and in some cases brings down some of the adoption barriers, you have to be mindful of the type of supplier network model that a vendor is suggesting for you. There's 3 types of models, and they can have a big impact on the likelihood that your suppliers are actually going to sign up for this, that this is something they're going to want to do. The first model is that there's a payment your suppliers make based on the percentage of their spend. They pay an implementation fee, you pay an implementation fee, and they pay a percentage of their spend in order to use the network. What's more, you're going to pay a per invoice fee. So you're holding the bag on a transaction charge as well. Suppliers are obviously very reluctant to give up a percentage of spend in exchange for sending you electronic invoice. This is why many of them say, I'm just going to send you a PDF. That's good enough, right? What you want to look for is a model that doesn't charge suppliers. The second model is a supplier flat fee model. Here again, you're stuck paying an implementation fee as well as a transaction fee per invoice, and your suppliers are paying a flat monthly fee in order to use the network to submit invoices to you electronically. While giving up a percentage this is more appealing than giving up a percentage of their spend, suppliers are still reluctant to use this. What you want is the model where suppliers pay nothing and you pay no implementation fee. You simply pay a transaction fee per invoice. It's predictable and it's appealing to your suppliers. The third component of AP automation to consider is workflow. We know that approving invoices and managing exceptions can be a huge burden for organizations. It feels like a fire drill in many cases, with folks moving in multiple directions, and in many cases, invoices simply getting stuck because no one knows what to do with them. What's more, this is the type of environment where invoices become lodged at the bottom of somebody's inbox. Somebody goes off on vacation or on a business trip, and nobody knows where things stand. So what we want is an environment with an automated workflow where we use business rules and thresholds to automatically determine how it is that an invoice should be handled. And automated AP solutions do just that. In fact, you're able to set rules based on different scenarios. Maybe it's the business unit, maybe it's by the invoice amount, maybe it's by the purchaser. You're able to configure all of these rules largely on the fly to set up digital workflows that eliminate the whole need to track down purchasers and nag purchasers to respond to an invoice. What's more, automated alerts, notifications, and escalation procedures ensure that things keep moving all the time. Nothing gets stuck in an automated workflow environment. And if you have POs, even better. Now we have the opportunity to automatically match invoices with purchase orders and even shipping documents to automatically process these transactions straight through without anyone even looking at them, if that's what your business rules allow. What's more, exception workflows allow us to, again, set up rules for how it is we want exceptions to be handled. And all of it's done digitally. No more back and forth emails, no more phone calls that frustrate suppliers and stakeholders. I hear from businesses all the time that it takes them 2 to 4 weeks to resolve a single exception. All the while, the clock is ticking. Late payments are coming. Suppliers are calling and getting frustrated. Early payment discount opportunities are vaporizing. And reporting is hosed up. And so three-way matching, exceptions workflows, and approval workflows resolve all these issues. What they do is they automatically allow for manual delegation of authority validation. You can set the rules for who it is that approves invoices. It automatically allows for duplicate invoice checking to root out those duplicate payments and that needless approval workflow. It can validate GL coding. It allows for data to be captured automatically and passed downstream so everyone has access to the full stream of data. It allows you to automatically archive information digitally so we no longer have to have paper file cabinets. What's more, with approval workflows, it's easy to train users on how to make approvals and resolve exceptions. And all of this in a PO-based environment can be completely touchless, so you can achieve those maximum cost savings. What's more, you can now use your mobile device to automatically approve invoices no matter where you are. We're no longer tethered to our PC in the office. So in the case where purchasers are frequently on the road, and that becomes a bottleneck for invoice approvals, they can simply reach for their phone or their tablet. They can review the invoice and any related data. They can even look at invoice history, and they're able to make a decision on that invoice instantly. IOFM data tells us that within the next 3 years, most businesses expect that most of the invoices they receive will be approved via a mobile device. You want something really impressive? 3 years from now, 10% of all IOFM members expect that they're going to approve all of the invoices their organization receives via a mobile device. Senior management loves mobile approvals. They can look at what's happening with invoices, payment data just in the palm of their hand. The next consideration for accounts payable automation is electronic payments. We often talk when it comes to AP automation about invoice processing. We sort of leave the whole payment piece off to the side. Well, it's imperative that businesses complete the last mile of automation. You need to think holistically about your payments. We, as consumers, are paying businesses more frequently using a card or bank withdrawal. There's no reason that our businesses shouldn't be doing the same. So I want you to think in terms of a strategy that combines automated clearinghouse transactions, or ACH, virtual credit cards, basically plastic-less transactions with a 16-digit credit card number that's tied to a specific transaction and a specific transaction amount, used one time for high security, and allows us to make larger ticket purchases. And of course, paper checks for those suppliers that simply refuse or in some cases are unable to take an electronic payment. Fact is that paper checks are losing their grip on business-to-business transactions. 59% of payments today are initiated electronically, according to the Association for Financial Professionals. Since the last Federal Reserve payment study in 2012, they found that there's been a 2.3 billion check reduction. Folks are simply writing fewer paper checks, and businesses should be doing the same. If you move to electronic payments, you now have the ability to capture cash back rebates on payments to suppliers made via virtual card. That savings can add up quickly. It's not unusual for businesses to capture tens or hundreds of thousands of dollars a year in cashback rebates. Some are even capturing in the millions. What's more, with electronic payments, you can have a configurable approval workflow, so you have control and visibility over the payment process. You get visibility into your cash position as well as the status of payments instantly, so you always know where things stand. Electronic payments are significantly cheaper than paper checks. In fact, studies show that a paper check costs 30 times as much as an ACH transaction. Virtual card payments, well, they don't cost you anything. A fee is charged to your suppliers. What's more, compared to paper checks, electronic payments are significantly more secure. They have better tracking, and they're responsible for a far less percentage of electronic or payments fraud among businesses. And your suppliers, they probably are looking for electronic payments. In many cases, they're asking businesses to pay them electronically. Today, more than half of businesses make their payments electronically. 54% of businesses view ACH as their preferred business-to-business payment method. It's easy, it's cheap, and it's transparent, and it's secure. 43% of businesses are now regularly looking to earn cash back rebates. You're not going to get it on all your spend, but it's not unusual to get it on 30% of your spend. And that can make a big difference in transforming your accounts payable department from a cost center into a profit center. The next component of AP automation is reporting and KPIs. We know that visibility is a big challenge in a manual or semi-automated accounts payable environment. Here, key information is not captured. Data is poorly organized, information is not timely, systems are badly integrated, and decision makers can't access data. And that all has to do with paper and fragmented systems. The C-suite gets it. 45% of controllers say they lack visibility into invoices and payables information. 42% of controllers say they have difficulty handling, managing, and finding invoices when they need it. They simply can't lay their hands on the information they need to do their job. 38% of controllers say the cost to process invoices are too high. And this has a lot to do with those opaque workflows that we talked about a few moments ago. And 17% of controllers say their organization has difficulty capturing vendor discounts. They simply can't see the opportunities that exist and when it makes sense to capture them. You got to do something about this. In the future, your enterprise is going to demand more real-time access to AP data. They're going to want that information, and they're going to want it so they can measure KPIs, so they can communicate with the C-suite on strategic initiatives, so they can deliver improvement strategies from an operational as well as strategic standpoint, so they can identify volatility that might impact the business negatively, and so we can manage our day-to-day operations. All of this can be fueled by ready access to accounts payable data. Think of all the information that flows through your organization. And what do we do with it? We put it in cardboard boxes and file cabinets. In many cases, we truck it away to an off-site location. Then we only go look for it when a supplier squeaks or an auditor comes a knocking. Simply shouldn't be this way. That data is far too valuable. And finally, the sixth component to AP automation is ERP integration. Be leery of vendors who say they integrate with any ERP. What you want is successful ERP integration that synchronizes data across business units and applications to allow for two-way data sharing. This is critical, folks. Ask your vendor if they're able to provide this, or if all they're doing is puking out a file that's being uploaded to some ERP system somewhere down the stream. One consideration when you're looking at all these different components is whether to deliver them on-premise or via the cloud. With on-premise solutions, well, yep, you have the opportunity to be customized at a significant cost. On-premise solutions also come with significant capital expense for hardware, software, infrastructure, as well as professional service fees. On-premise solutions, they also require a longer implementation. People have to be at your site to put this stuff in. And on an ongoing basis, it's going to require significant support from your IT department. The good news is SaaS solutions today, those in the cloud, offer you a pay-as-you-go model with low risk, low total cost of ownership, and a faster return on investment. What's more, SaaS solutions have shorter implementation time frame, no upfront infrastructure, and little ongoing support on the part of your IT department. All of this is owing to the cloud. The vendor is on the hook for managing all of this. And that's where the benefits come in. According to AP practitioners, they see the biggest benefits of SaaS and cloud solutions as being minimal IT involvement, no capital investment, no software hardware costs, and a lower cost per invoice. All of this means a faster return on investment, faster benefits. And don't buy into the myth that SaaS is a trend, or that it's only available for skinnier pre-built versions of the solution, or that it's less reliable. Those are simply not the truth anymore. And that's why SaaS and AP has grown at 40% per year, and why it's a priority for many accounts payable departments. So if you want to achieve best-in-class results in accounts payable, you're going to have to automate. But the benefits of automation are not assured without the right solution. Use the 6 components we talked about today, as well as a strong consideration of SaaS components. And I assure you, your organization will maximize its benefits from AP automation. But don't take my word for it. I want you to talk to my friends at Corcentric and ask them your questions about automation and see how it is they can help you on your automation journey. The contact information is on the screen, and I invite you to visit their website to learn more about their solutions. On behalf of Corcentric, this is Mark Brousseau. Thanks again for joining us. Have a good day.